Sandip Sabharwal as well joins in this morning. And Sandeep, its nerves are all round on the Lal Street, be it whatever factors, but it seems that renewed strength that we had seen on the very strong likelihood of the Modi-led coalition winning the elections seems to have run into rough weather. Global trade tensions, rupee, crude, nothing really seems to be supportive at this juncture.
Yeah, that's true, and I think there was excessive optimism which got built in a couple of weeks back, and we've seen some unwounding of that. Now, I think we should not discount whatever is happening between China and the US so fast, because it's a significant global development, and the way it is positioned right now, it doesn't seem that it will get resolved as fast, although both the sides want a resolution, but I think the positions have got so entrenched now that it will be tough to break that in the very short run. Now, what that will do is that one, as tariffs kick in, obviously it will have an impact on prices in the US. So if prices start going up, it impacts consumption. So it's an entire spiral which starts. And the biggest factor we have to watch out for is how the yuan behaves, because a sell-off in the yuan, as it has seemed to have started over the last few days, will have a spillover impact on other emerging market currencies. And typically, when currencies fall, the markets don't do as well. So I think there are several imponderables, and the second part is that you talked about the return of the Modi government. So that is something which we don't know. So if it happens, then India will break away from the performance of the other markets and chart a course of its own for once if and when that happens. So I think that's something we need to watch out for. But right now the markets are moving more on global developments. Technically, also in terms of traders positioning, I believe that most are positioned in a manner where they are just looking to buy on dips. Everyone thinks market is oversold, it should be bought for a bounce, which is also not a very good psychology. So I would think that markets could possibly give up a few hundred more points and then stabilize.
A greed and fear index seems to be capturing a mood of fear. It's no longer capturing a mood of greed. It's a contraindicator. If you go in the zone of extreme greed, extreme fear, and you stay there for some week or two, then trust me, it may turn out to be in great contra buying. While Sandeep is making a good point on Nifty, remember in mid and small cap stocks, a lot of chop and churn has already happened. Stocks have been diced and sliced, and best of the HNI investors I've spoken to, all they are doing is that either they have gone on a long holiday or they are not participating. In this kind of a market, nobody's ready to say, okay, I'm going to be coming out and I'm going to be committing my precious, money to buy into stocks ahead of the election. After election, depending on the verdict, you may see movement and you may see action and excitement, but before that, I really don't expect anything large or sharp. Sandeep, let's talk about Tata Steel. Now, we've spoken about SBI at length, but Tata Steel, the fine print is evident that this is like the worst possible news for Tata Steel. One side you've got global trade war, then you got problems in Europe for steel cycle, and then on top of that, whatever Chandra tried to deleverage the balance sheet of Tata Steel, and they wanted to get the baggage of chorus out, looks like the problem, I think, is, it does not look like, but we know that the problem has not got sorted out.
Yeah, so the problems not got sorted out, but they are relatively in a better position because right now they have been reducing debt despite all the pressures which they have. But obviously, if there's a slowdown in the global economy, and we've seen quarter-on-quarter decline in steel prices after they had moved up, then given the integrated nature of Tata Steel, obviously it has a negative impact. And overall metals, because the Chinese economy will get hit very severely by whatever is happening, because it was exports which were sustaining the economy when the domestic factors had got impacted severely because of the lending binge and the fact that over leverage had played out, and there's so much of overcapacity in many industries in China. So that obviously has an impact on global commodities. So global commodity plays will also be under pressure. So specifically on Tata Steel, I would think that it could be avoided at this stage.
Sandeep, you've been favoring L&T for a while now, and now the earnings over the weekend, Street is pretty impressed. They've managed to maintain their guidance, forecasted a strong order inflow from here onwards as well. There's been pickup in execution. But do you buy stocks like NCC, L&T afresh now?
Yeah, L&T is in a good position, and if you look at relatively how many of the large caps have delivered, and on top of that how L&T has delivered in an economy which has slowed down so significantly, which has not gone anywhere. It's because of their global presence and operations across the world, and it's working as a global MNC in a way. So the valuations do not fully capture the growth prospects of L&T at this stage, as well as how well their subsidiaries have done, and the value those subsidiaries add to L&T stock price, which is estimated to anywhere between 400 to 500 rupees per share. So I think in this corrective phase, for those who don't have L&T, I think it's definitely a good stock to buy.
There's also ITC, Sandeep, that's going to declare its numbers today. We're expecting that the price hikes will aid the overall top line growth. Cigarette volumes, according to the ETNA poll, is seen at about 6%. What are you factoring in for ITC? What are the most important parameters?
So ITC obviously continues to be one of the cheaper FMCG stocks, and its discount to HUL is at a pretty substantial level relative to historical trends. The key factors obviously in ITC always are how the FMCG business X of cigarettes is performing, and whether profitability is increasing there, and how their strategy out there is playing out. Because cigarettes, just doing well in cigarettes or not doing well in cigarettes on a quarter to quarter basis is not going to change the valuations of ITC or increase the valuations. For that to happen, the rest of the FMCG business has to start becoming more profitable, and that will be the key thing to watch.
Okay. One more stock which is there on a stock edge today is HCL Tech. The stock on Friday, now numbers came out on Thursday evening, markets reacted to them on Friday morning. That's where HCL Tech is positioned. The stock in this year, when rupee has not been exactly very favorable, has given decent returns. The thing with HCL Tech is that the valuations are one of the lowest in the top IT league. They're trading at a deep discount to Infosys and a very fat discount to TCS, but their margins again are not the best in the industry, and that historically has always capped the future progress of HCL Tech. I mean, they may be saying all the right things in terms of growth, reboot, DNA, but even though consciously they're trying to get rid of the legacy business, the infrastructure maintenance vertical, their margins are not the best in the industry, and the P multiple for HCL Tech currently is at a very deep discount to what something like a TCS has to offer. So Sandeep, TCS, we all know it. It's a success story. It's a stock which is expensive. They're promising a 10% growth, not promising, but they're indicating a 10% growth, but you're getting that 10% growth at a P multiple of 24, 25 times 1 year forward. With HCL Tech, you're getting a 10% growth, lower margins, but a P multiple of 14, 15 times.
Yeah, that's true, but what HCL Tech has guided for does in no way actually creates a scenario where the discount with TCS could get bridged. Because if I remember what TCS said, they said they'll grow in double digits. They didn't say it, but they indicated it, and they said and there's an expectation of margin improvement. On top of that, if you look at HCL Tech or even Infosys, they will grow slower than or at par with TCS, but their margins will come down. So then there's no reason for the discount to actually dissipate. And HCL Tech on an absolute basis has done very well. In fact, I think it hit a 52-week high also before correcting. So to that extent, if you actually see a lot of portfolios also, because of this discount factor, many people have bought into HCL Tech. So it's a fairly very well owned stock now, and it's not primed for any disappointments.